Want to know how you can gain access to capital to jumpstart your journey to entrepreneurial success? For entrepreneurs who are just starting out or those who have been in business for years, Minority Business Access is your podcast. Welcome to our show, where we will guide you in avoiding the pitfalls and thriving in your chosen business. Now, on to the show with your host, Solomon Ali.
Thank you guys so much for being here to Minority Business Access. Thank you again for joining us at MBA. We look forward to going over some more information. The team has done a really awesome job. Have to give them credit. They're doing everything they possibly can to ensure that you are successful. So we just need you to go ahead and dig in and do some research and everything on your own so that you can be successful as well. And keep in mind, please, success is what you think it is. It's not what I or someone else think it is. It's what you think it is, okay? So let's not get caught up in the labels of what something means or doesn't mean. For each individual, they have their own idea of what success is. All right, so today we're going to talk about investing in a company. Okay, basically what to look for. We've talked about it previously before on what to look for and how to invest in a company. So we're going to do that again today and kind of get a good idea of what we should be looking for and what we should be doing.
Hey YouTube, I'm Jimmy. In this video, I'm going to walk through how to research a company and ways we can learn to become a better investor. I plan on starting with the very basics, and I'll give ideas along the way for how we can take our investing game to the next level. So I've been investing for over 15 years, and I started investing shortly before I went into college. Then I got my bachelor's degree, I got my master's degree, and I'm currently working towards my doctorate of business with a specialization in finance. But my real love for investing came from when I was young, and my father worked on the floor of the New York Stock Exchange, and that was really my early introduction to investing. That being said, I understand that investing can seem intimidating for people who have never been around it or have never done it for the first time, or if you're just starting out, the process itself can seem, quite overwhelming. So what I'm hoping to do here is I'm going to break down the actual process I go through whenever I analyze a new company. And I believe that if we follow this process, we can all get really good at analyzing companies and ultimately picking companies to invest in. So if you're not 100% confident on how to read financial statements, I think that this book is a fantastic place to start. It's called Warren Buffett and the Interpretation of Financial Statements. And I got an Amazon link in the description below. But I like it because it's very simple. That's really the reason I love this book. And as you can see, it's quite a small book and it's super easy to read. Now, I think that Mary Buffett, she's one of the authors. I think that she used to be married to, or she still is married to, I'm not sure, married to Warren Buffett's son. And although this is called Warren Buffett and the Interpretation of Financial Statements, I can safely say after reading it that this is not a shortcut for thinking like Warren Buffett thinks as far as investing goes. But I'm not even saying that's why I would like the book. What I'm saying is that they do a fantastic job of making it very, very simple. They walk through different key ratios, different pieces of each of the financial statements, and I think it's an amazing place to start. If you want to learn how to read financial statements like Buffett does, then Ben Graham's book, Security Analysis, is the place to go. But I read that book, and I love reading about this stuff, and that is a really tough book to read. That book took me over a year to read. This one took a couple hours. I mean, it's really quite simple. Okay, so now let's pretend that you're comfortable with the basics of financial statements, and you could probably move on to these next steps, even if you have just the very basics, just a very basic understanding of financial statement analysis. And I put links to the videos that we created.
I'm going to speed this up a little bit. All right. He's showing the income statement. He's showing the cash flow statement. And he's talking about reading the balance sheet. People, we talked about that several times on many different podcasts, going back over a year and even bringing it forward. Come on, income statements, you have to know what makes up the income statement and why certain things are relevant. The thing that I always look for and I spend a lot of attention on is the cash flow. I'm looking to always see if a business is struggling. Why is it struggling? Are they carrying too much debt? Do they have too many expenses? Things of that. I'm always looking for the cash flow. And then the next thing I'm looking for is what makes up the cash flow. Where's the cash flow coming? Is it reoccurring business? Is it contracts? Is it like in retail where you have to sell something new to a new customer every single day? I always want to know what makes up the cash flow. How's that money coming in? Balance sheet, that's a pretty simple one. And again, you need to know what makes up the balance sheet of a company. And so he's going to probably get into that. I'm going to break in and give you my opinions as he's giving it and tell you what pieces that you should really possibly, in my opinion, focus on more so than others and what you might be able to disregard. Okay, but these are the nucleus when you're looking at a company. It's this here, 10Qs, 8Ks, and the K. All right, you got to look at those things and management discussions. Those are the nucleus of actually making an informed decision into a company, okay? Because that should give you everything else. If management's done a really good job on their filings, and when I say filings, I'm talking the 10Qs, the 8K, the 10K and stuff like that. If they've done a good job on that, they'll actually talk about their competition, what the industry and everything is doing. Then what I normally do, and you can do this too, go pull up some of the competition, especially if they're public as well, look at their 10Qs, 8Ks and everything like that, and compare it and see what's going on. And, even with the financials and stuff like that here, what you want to do is just compare and see, hey, the company that you're thinking about investing in, where can it make improvements? Okay, where is it lacking? Where is it falling behind? So, and you might want to pick up 2 or 3 of the companies. The number 1 company, you always want to stay within number 1 through 5. And within that industry, okay? And then you just compare everything and you just kind of look at it and see, because then you'll see, oh wow, one company's balance sheet might be extremely strong. What's making it so strong? And when you compare it, you'll be able to see that information. They may talk about on their management discussions certain things that the company you're thinking about investing in is not talking about, and you might see 2 of the other companies talking about it, the competition. So that might mean be a red flag and say, oh, wait a minute, that's a huge indicator that the industry is going in a particular direction, but the company I'm thinking about investing in hasn't even mentioned it or talked about it yet. Okay, so they should at least mention and talk about it. They may not go in that direction, but they may say, hey, everybody else in the industry is going over here and they're expecting to do this, but we're going to go in this direction and we think we'll get this particular outcome. So you want to make sure the company that you're investing in is doing what's normal to the industry, but also breaking away from the industry and setting the bar higher. Okay, let's go ahead and go back to the video.
On each of the financial statements in the description below, and you could probably get away with just that for now. But I think the key to really becoming a good researcher and ultimately a good investor is being able to analyze a company's business or understand the business itself. So now let's look at how we can learn about the business. And if you're wondering, these are the exact steps I go through for every company that I research, either for work or for when I'm making a video. However I do it, these are the steps. There's 8 steps in general that we go through. Okay, so let's pull up any company. How about we start with the next company that I'm going to cover for the Dow 30 analysis, Goldman Sachs. So the first step is to pull down the most recent annual report, which is called the 10K. Now, 10Ks are required to have a certain amount of information in them. One of those sections, one of the requirements, is that they have a business description in it. So whenever I start with a new company, or even if it's been a while since I last analyzed a company, I always start with the business description. This is the business description for Goldman Sachs. And here they break out the segments, they break out what the company does. And this one's about 20 some odd pages, and they're all usually in that area, call it 15 to 20 pages. So this isn't your typical, they throw a description.
Now, I just mentioned this, okay? So the 10K, That's the year end, people. That's the year end. That's everything that happened within that 12-month period. That's what that is. Now, segments, I'm going to say you can forget that, toss it. Again, we're talking always operations. What's going on with the operations? Are they spending too much money? Do they have too many vendors, too many employees? I mentioned before on another podcast, right? The government puts out how much money a company is producing and how much each employee within that company contributes to that revenue. That's really, really important to understand and to know. So anytime you make an investment, you're going to be looking for that, okay? And so you'll take the operations and you'll say, oh, okay, they got X amount, their payroll is this or whatever, right? And you're going to look at what that operational cost is, and then you're going to go over that government report, and you're going to say, okay, these guys got 300 employees and the company's doing, let's say, 300 million. Say, oh, okay, well, that company's doing pretty good, because basically the breakdown is that each employee is contributing to $1 million of actual revenue to the company. But now let's say if you had, I'll just say 3 million employees, all right? And the company was doing 300 million, right? Well, now all of a sudden, that's not looking as good. So that would probably tell you just like that you have too many employees. So the company could stand to what? Cut back on some employees, okay? But they can't do that if they're not proficient and they don't have their what? Infrastructure all together and streamlined. So that's what looking at everything in operations. And that's what you're looking for. You're looking to see, okay, are these guys running it efficiently? Are they running? And who are we talking about? We're talking about the CEO who gives the orders and everything like that to the VPs. The VPs who give the orders to the management team who gives the orders to the supervisor, and then the workers who are actually doing the execution thereof. Everything has to flow like a well-oiled machine. And you'll find and discover if they are or if they're not right here. That's where you'll discover. The other thing is, you hear me talk about it all the time, industry. What is the industry doing? What's the top 5 companies in that industry? I know everybody likes number 1, number 2, and number 3, but what are the top 5 companies in the industry doing? Okay, you have to look at the industry, the company that you're looking to invest in. What are they bringing new to the industry? What do they have that's a little bit different than those top 5 companies? Okay, that's very, very important. If everything is the same, then how are they going to basically gain more market share? What are they going to do that's so unique within that industry to gain market share? All right, and they should, if they're probably not going to tell you in the industry section, this section called management and discussions, they should be talking about it there. So we're going to get back to the video. He's doing a really good job. I like his method of what he's doing and how he lays it out. He's doing a really good job, and it makes it, in my opinion, it should make it really simple for you to actually understand it. It's kind of like what we do at Solomon RC Ali Corporation. So if you go to our website, I mean, we're not going to have Goldman Sachs as one of the companies that we're looking at. We deal with small cap and penny stock companies, right? Now, you guys hear me say penny stocks. Definition of a penny stock, for those of you who don't know, is any stock that trades under $5. Okay, let me say that again. A penny stock is any stock that trades under $5. Okay, that's a penny stock. All right, so it doesn't really matter what platform they're on. You could have a stock that's considered a penny stock that's trading on NASDAQ. If it's trading under $5, typically they consider it a penny stock. Most commonly, penny stocks are known as stocks that are under, let's say, $1, that are on a OTC markets or pink sheets or something like that. That's what most people associate it with, but the true definition is any stock that trades under $5. It doesn't matter what platform it's on, okay? So let's get back to the video. He's doing a really good job, and let's find out some more and see what other knowledge.
Description out there, they do a really good job, at least Goldman did in this example, of explaining what the business does and how they make money. Now, many times when I first start researching a company, this may be as far as I get. If I get through this section and I don't like the business itself, or it's too complicated, or I question how many prospects they're going to have over the next few years, then I could just stop here. And I think that this is an important point because you can bail out on a company at any time. You don't need 1,000 good investments. All you need is a handful of great ones, and you can make a killing with your investments. So I think we all need to be very picky about. So now we're on to step 2.
Now, he's talking to the portfolio investors, people looking to build a portfolio. People, you want to do the due diligence. You hear me stressing that and stressing that and stressing that. That is on you. If you want to be successful, it is up to you. All we can do is give you the tools. It's like if I give you a screwdriver so you can screw a screw in, right? And you decide that you want to use the back of some pliers to do it, you just made your job a whole lot harder, if not impossible. But if you take the screwdriver because you have the right tool for the right job, you made your job a lot easier. And so that's all we're trying to do is give you the right tools, the right information, so you can make an informed decision, but you got to go do the work. There's no substitute for doing the work, people. You have to do the work. The other thing is you want to eliminate the risk. When you do your homework and you check out these companies and everything, you're eliminating or you're bringing your risk down, okay? So, and that's very important to bring that risk all the way down. So we're going to get back and I'm going to hush up and let him go for a little while until we get to a point that I think is really important to make a comment on.
Now we're about the companies that we elect to ultimately put our money in. Okay, now we know what the business does, so now we're on to step 2. Now we're going to read the most recent management discussion and analysis section from their most recent filing. If it was their annual filing, the same place you got the business description, great. Otherwise, you have to pull down the quarterly filing, which is called the 10Q. Now, the business section is usually only in the 10K, but the MDNA section is usually in every one of their quarterly and annual filings. Now, sticking with our Goldman example, Goldman's annual report was filed on February 26th of 2018. It's now November, so it's a bit outdated. But their last quarterly report was filed just 2 weeks ago. So we know the business section is from back in February, and the MDNA section is just from 2 weeks ago. So in the MDNA section, we're going to learn a lot about the business, what the management team is trying to do with the business, what their plan is. They might talk about the industry, maybe what different trends that are happening in the industry. They're likely to break down the financial performance for each of the sectors. And basically, they're going to talk about how the business as a whole is performing. Just back.
Number 2 is critical. The MDNA is critical. You must read this section. There's no ifs, ands, and buts. You need to read this section, and you need to read it several times. And a good thing to do is take this, see what your team is talking about, the company you're thinking about investing in, look at some other companies in the industry and see what they're talking about. Also, another really good one is, and I kind of mentioned this earlier, the industry trends. What's happening in the industry? So I'm going to look at my company, Newco, and I'm going to say, okay, Newco's talking about these particular trends. And then I'm going to run over to its competition, and I'm going to look and see what trends they're talking about in the same section. Hey, what are they saying? What do they believe? And I'm going to see if they're kind of all within line, okay? If my ABC might be blowing a little smoke. They might be a little over optimistic, all right, for what they're trying to achieve, but everybody else is more in line of what's actually happening. If the industry itself is only growing by 3 to 5%, and these guys are talking about, ABC is talking about they're going to grow by X, right? Well, there's only one way they can do that. So if they say they're going to grow by, let's say, 30%, how can they grow by 30% if the whole industry is only growing by 3 to 5? Well, there's only going to be one way, and that means they're going to have to take market share from the other companies, from its competition. So now you get to understand real quick if they have the ability to take market share, because you're looking at it, right? So you're going to look at their performance in the past. You're going to look at what they say, hey, this is what we're planning to do. And then you're going to go back and you're going to look at management. And you're going to sit back and say, hey, can they really do that? They haven't done it in the past. They've been in the business for this long. So why will I believe today that they will be able to take market share from the competition who's outpacing them? All right, very important. See, a lot of this is going to come down to simple common sense. It ain't rocket science. It's really simple common sense. So if all of a sudden, let me break it down this way. You pick your team. When every one of you have a team, whether you were in high school, college, or you have a pro team, you all had a team. If you went to school, you normally voted for the home team. But you look at the stats of your home team, if they had a winning stat and then they were going up against a company or a team that had losing stats, right? You kind of knew, unless something really remarkable happened, that your team might be favored to win and that they were going to win the game. All right, so the other team will have to play exceptionally well. Your team will have to play exceptionally, very poorly for the other team to win, right? Same in business, people. This is not rocket science. So when you start comparing the management teams and you start comparing what's happening in the industry, now you can use some common sense. You use some logic. And it's like, oh, wait, that doesn't make sense. There's no reason, I think, let's say, hey, Solomon can beat Bolt in 100 yards, okay? Solomon's never ran better than a 10 flat. And Bolt runs a what, 9-1 or something, 9-2? So it's like, oh, okay, common sense, people. It's that simple. It's that black and white. Everyone wants to put more onto it than it actually is. It's common sense. The common sense comes only in, though, if you do your homework for you to be able to make that decision. But if you're saying, oh, my friend told me it's a hot stock in this, and you go jump in, or it's a really great company and you go jump in, well, you're probably going to lose a little money because you just threw it to the wind. Okay, so we're going to get back to it. Overall performance is good, but when I look at overall performance, what they're talking about here is the overall performance quarter after quarter, year after year, right? I don't really look at that. And of course, they're always going to try to put a nice positive spin on it, so it doesn't sound as bad as it actually is. What I look at when I say overall performance, I'm going to who's number one, who's number two, and who's number three. How did they compare in overall performance to number one, number two, and number three? I'm not looking at how they compare to themselves. Okay, very important to remember that. All right, let's go back.
You know, you might want to update those numbers in your head as you're reading through the quarterly MDNA section. Okay, and this kicks us right over to step 3, which is onto the financial statements. And I highly recommend that we pull those financial statements directly from the latest quarterly and annual reports, because these financial statements come with the footnotes, and the footnotes can be key to understanding the financials. Often, a company does something unique with a particular line item, and in the footnotes, they explain what they're doing and why they're doing it. So if they were ever going to, let's say, change an accounting rule or adopt a different accounting rule, well, we should probably just Google what that accounting rule change is. And I think that this type of practice can get us really good at exposing ourselves to different types of financial statement analysis. And I think that the more we look at the actual financial statements, not something off of, let's say, Yahoo Finance or whatever it might be, go to the actual source. And if you have a question about a particular line item, look at the footnotes. They'll probably explain it there.
Let's stop for a sec. There's something that he hadn't mentioned yet. The management team, along with its auditor, okay, and professionals that put the financials together, have a legal obligation to be completely transparent in the numbers and everything. They have a legal obligation to be completely transparent in the financial statements. So the auditor is not just because he like Joe, the CEO of ABC company, just lets some fluff go. Typically, that's not going to happen, okay? The CPAs and everything, these people have licenses and everything, their credentials on the line. So typically, they're not going to cut too much slack there. The financial statements have to be completely transparent, all right? And so that's what the gatekeepers are there for, is to make sure those statements are ready for investors so investors can make an informed decision either to stay in, get out, buy, whatever, okay? So he didn't mention that, so I just want you to know that you can place a lot of weight on that, but although you can place a lot of weight, there's no weight like doing your own homework and comparing that. So even when I look at these financial statements, number one, number two, and number three in the industry, are these financial statements lining up with number one, number two, and number three? What do their financial statements look like? Okay, there may be not enough in here. There may be too much. Now I'm looking for the why, okay? And you should be doing the same thing. Okay, let's get back to it.
Now, I bring up the dates because I think it's important to remember, if you're reading the business section and it was from almost a year ago, well, just keep that in the back of your mind. You know, you might want to update those numbers in your head as you're reading through the quarterly MDNA section. Okay, and this kicks us right over to step 3, which is onto the financial statements. And I highly recommend that we pull those financial statements directly from the latest quarterly and annual reports, because these financial statements come with the footnotes, and the footnotes can be key to understanding the financials. Often, a company does something unique with a particular line item, and in the footnotes, they explain what they're doing and why they're doing it. So if they were ever going to, let's say, change an accounting rule or adopt a different accounting rule, well, we should probably just Google what that accounting rule change is, and I think that this type of practice can get us really good at exposing ourselves to different types of financial statement analysis. And I think that the more we look at the actual financial statement, it's not something off of, let's say, Yahoo Finance or whatever it might be. Go to the actual source, and if you have a question about a particular line item, look at the footnotes. They'll probably explain it there. Now, step 4 is get the company presentations and recent earnings calls. Now, steps 2, 3, and 4 can really be pushed together or swapped around, because for me on a personal basis, after I read the business section, assuming I still like the company, well, I go ahead and download everything from steps 2, 3, and 4 all at once, because each of these are often interdependent, and sometimes they say the same thing in each of them. So I think it's a bit faster just to download them all at once and start going through them together. Now, up until this point, we've made no attempt to value the company. All we're doing at this point is getting to know the firm, understanding what they do, how they make money, where are their margins, what does their growth rate look like, do they have free cash flow, how does free cash flow look, what's management's plan, do we think that their plan is reasonable, things like that. During steps 2 through 4, those are the questions you're trying to answer. Okay, now in step 5, now we need to find...
Let's stop for 1 second. There's something I forgot to mention in other podcasts, including this one, and he forgot to mention it as well. Not only are we going to look at the competitors, we're going to also look at what third party is saying. What are the analysts saying about the industry itself? So what are other people actually saying about the industry? So Solomon R.C. Ali Corporation, we do that as well. We make sure, hey, what are the press releases coming out? What are analysts saying? What are the trade associations actually saying about the industry and everything like that? So you want to just not look at the information that they're putting out or the information the competition is putting out. What is the third-party information being put out there by third-party analysts, by third-party consultants, things of that nature, press release, business writers and stuff like that? What are they saying? Okay, so that's very important. Please keep that in mind.
This one better. Maybe I'll switch over to that company, to that competitor, because maybe they have a competitive advantage that we identified, So what we do is we start this exact same process over with them. But this time, imagine how much easier it's going to be to understand that business, read the management discussion over there, because now we're going to know that business so much better. We're going to know the industry, we're going to understand the language so much better. So the second, the third, the fourth time we do this for similar companies, the easier this is going to get. But now let's imagine that we still like our company. So now what we want to do is we want to try different valuation methods. Maybe we try discounted cash flow or PE multiple or EV to EBITDA. There are lots of choices, and the more experience we get with different types of companies and different types of valuation methods, the better we'll get at choosing which one is appropriate for that particular situation. Now, this is also where you want to compare the company with their competitors, compare their ratios, also compare the company with themselves from prior years. If management says that they have a particular plan in mind, well, how long is that plan in place? Are they actually working it? Can we see it in the numbers? And for me, I think you can learn a ton about a company with this type of analysis. Digging into the differences from year to year or from company to company can really point out a lot. Personally, this is also where I like to find industry associations. Often, these types of groups can do a great job of explaining the industry, explaining the potential of the industry, maybe the projections or the future of the industry. And I think that this is great to identify what our company does, what their competitors do, where they...
Now, determining fair value, that's fairly simple. It's not that complicated. But I want you to keep something in mind, because a lot of people, we have a thing that's called day traders. Day traders jump into stocks and things of that nature because they hear good news, some exciting things that's actually going on, right? So they jump in, create a lot of volatility, stock price and everything goes up, and then they turn around and talk about management and everything of that nature, that management's not performing. Well, people, it's extremely important to understand when you're investing, it's not quarter by quarter. You need to really be looking at it long term, because it takes a time to roll out a plan. It takes time to get a plan executed, okay? So you can't go with the highs and the lows of what the rumors or day traders are doing based on, hey, all of a sudden you get a lot of buying into the stock, so it's a lot of volatility, and you go jump in, right? Well, you don't know why you jumped in, and then all of a sudden, they're like, oh, well, the company's not worth that because management hasn't done A, B, C, D, as they said. And these days will sell it like these people should have done this in the 90 days. It doesn't work that way. It takes a year sometimes, 2 years, and sometimes even 3 to 4 years to get it done. Let's look at Amazon. Have you guys heard of Amazon? 14 years of losses. 14 years. So if the day traders are sitting back there saying it's a lousy stock, I bet you they're not saying that now. Oh, I'm sorry. They probably can't even afford the stock today. Okay? So that's what you have to be looking at. You got to do your own homework. Everything's going to come back to you have to do your homework. It's up to you, okay? If you don't do your homework, it's no one to blame but yourself. So when we're looking at fair value, don't look at what's happening to the stock or anything of that nature, people jumping in or jumping out. You go do your homework and look at, hey, how the value has been determined. Is that by earnings per share? How has it been determined? Okay, very important. Did they use the discounted cash flow method? So there's a method that these companies are using, and which method is the most popular method? And is the management team working and getting it done?
Competitors. So in their MDNA section, or maybe in the business section, or maybe in the earnings call, well, we would have come across hopefully something about the industry. And now we need to identify competitors. Ideally, 2 or 3 of them. If we could do that, I'm happy. Now, at this point, we know the company well, and you know what they do, you know what they're planning to do, you understand where they're going. And now, once we find competitors, what we want to do is we want to read a little bit about each of the competitors and try to understand what their plan is. What's their growth rate like? What's their margins like? What business line are they trying to go into? And sometimes, if let's say you see a big difference in margins between one company and another, you could look at, well, why is there such a big difference? Sometimes this reveals a competitive advantage that one company has over another. So now once you understand the very basics of what the competitors do, You pick 2 or 3, and we move on to step 6. Now we want to try to value our company. Now, assuming that we still like them, of course. Now, sometimes you'll come across one of the competitors and you'll say, I like this one better. Maybe I'll switch over to that company, to that competitor, because maybe they have a competitive advantage that we identified. So what we do is we start this exact same process over with them. But this time, imagine how much easier it's going to be to understand that business, read the management discussion over there, because now we're going to know that business so much better. We're going to know the industry. We're going to understand the language so much better. So the second, the third, the fourth time we do this for similar companies, the easier this is going to get. But now let's imagine that we still like our company. So now what we want to do is we want to try different valuation methods. Maybe we try discounted cash flow or PE multiple or EV to EBITDA. There are lots of choices, and the more experience we get with different types of companies and different types of valuation methods, the better we'll get at choosing which one is appropriate for that particular situation. Now, this is also where you want to compare the company with the competitors, compare their ratios, also compare the company with themselves from prior years. If management says that they have a particular plan in mind, well, how long is that plan in place? Are they actually working it? Can we see it in the numbers? And for me, I think you can learn a ton about a company with this type of analysis. Digging into the differences from year to year or from company to company can really point out a lot. Personally, this is also where I like to find industry associations. Often, these types of groups can do a great job of explaining the industry, explaining the potential of the industry, maybe the projections or the future of the industry. And I think that this is great to identify what our company does, what their competitors do, where they fall over. We need to determine.
On number 7, he didn't mention it, so I'll just say it. He did a great job in showing the charts and articulating everything. Here's the thing. If you see negative news and the stock maintains its course, then you know on that negative news and future negative news, you probably don't want to move. That probably tells you that a lot of the investors in the stock believe in it, done their work, they're comfortable with the stock. But if you look in previously and you see negative news and people are jumping out and things like that, you got to probably look at it as one or two ways. I wouldn't jump out. I would probably see it as a buying opportunity, but you have to make that decision. So one way is you can jump out with everyone else and think the building is on fire. The other way is you can sit back and say, you know what? I'm going to actually average out and buy me a little bit more while I can pick it up cheaper because, again, I've done my homework and I've done all the due diligence. So just because everybody's getting out on the negative news, I still think management has the capabilities of executing their plan and getting it done. So keep that in mind. Also, if you hear good news come out, right, and all of a sudden, you know, there's a lot of buying when the good news come out, you might want to think about sometimes selling a portion of your position because there's a lot of volatility at that point in time. So you can get out while the stock normally tend to go up when there's more what? Buying pressure. So there's more buying than there is selling. So the stock price normally goes up. So the good news come out. You might sit back and say, oh, let me take a little profits off the table. So that's one of the strategies that we use at Solomon RCLE Corporation. That's one of the strategies that I personally use. And I would strongly suggest sometimes when you see good news coming out that you might want to always consistently take some profits off the table so that they can be reinvested at other times. You know, might be reinvested in the same company later in the future and things like that. So, but just keep that in mind. Let's go back to the video. So that's your, buying opportunities. And we're going to finish this off just by saying, look, guys, it's truly, truly up to you. No one can tell you what to do, when to do. No management team, no CEO, all they can do is give you their best guess of what they believe they can do, okay? That's it. What is their best best guess as opportunity of what they can do. And so they think they can do a great job. You're trying to basically read everything they're putting out and what the third party are saying, and you're trying to ascertain whether or not you think they're going to get the job done. And you're trying to give them a grade, like a teacher. Either they're getting an A, a B, or C, or D, or F. Now, it's not too many of these people who are running publicly traded companies or who are the founders of the companies that's going to get an F, all right? They have to royally just screw it up all the way. So that's really rarely happens. But there's not a lot of them on the other side that's going to get an A. That when they say they're going to get some things done, that they're able to just go execute, and they always are able to deliver, okay? So most of the people, what you're going to find is they're going to be in that B minus, C plus range. They're going to struggle to get some things done because you're going to have human nature and things like that. And what you're trying to do is figure out what grade are you giving them and what do you think they can achieve. So you want to put on your teacher's hat and you want to sit back and say, okay, is this realistic? Is this realistic based on their past experience? Not just with this company, but maybe with other companies that they have worked with. Is this realistic within the industry? Things like that. You're putting on your teacher's hat to give them a grade. It's up to you to do the homework. Okay? Listen, thank you guys so very much for tuning in to Minority Business Access. It's been a real blast of working with you and trying to give you this information. I really, truly hope you found it to be of great benefit. You know, my team goes out and they do all this research and trying to pick out some really good information to help you to do your job better, whether you're a CEO running a company, an entrepreneur looking to get into it, or just simply an investor looking to place your money into a company that's looking to grow. You can reach out to one of my team members or myself at solomonrcali.info. Again, that's solomonrcali.info. If you want to learn anything else, you know, we're going to continue to try to do Minority Business Access and bring good content to you that we hope that will be a benefit to you. Thank you so much, and it's up to you.
You've reached the end of another episode of the Minority Business Access Podcast. Connect with us at solomonrcali.info to leave a review and access more resources. We hope you enjoyed this show and found great value. See you at the next episode.